As of right now, Monday, April 27, 2026, the market is currently open and Nvidia stock is trading live at $208.27, representing a massive intraday jump of 4.32% from the previous close. This movement has pushed the company back toward its all-time highs, reclaiming a staggering $5 trillion market cap in the process. While most people are watching that headline price and thinking about whether they missed the boat, the real story isn't just about the gain, it's about the liquidity drying up on the sell side. We are seeing institutional volume patterns that suggest big players aren't just holding, they are actively moving into a scarcity mindset with this particular asset. The expectation in the broader market right now is that Nvidia stock is a momentum play that needs a cooling off period. You see it on every major social platform and in every news cycle. It's gone too far, too fast. But the reality is that the valuation, when adjusted for the fiscal 2027 projections, is actually becoming more attractive as the price rises. This is a rare paradox in online investing, where the expensive stock is technically getting cheaper relative to its earnings power. While Apple stock and Tesla stock have struggled with consumer demand cycles, Nvidia has managed to position itself as the infrastructure layer of the entire economy. If you are using investing sites to track these movements, you've likely noticed that the volatility isn't coming from retail fear, but from a fundamental shift in how data centers are being capitalized. Looking at the daily swings, the trading volume today has already crossed the 200 million share mark, which is significantly higher than the average for a Monday morning. This tells us that the institutional activity is aggressive. Large-scale funds are likely rebalancing their portfolios, moving away from high-risk, low-yield tech and anchoring themselves in the one company that has consistent 70% plus revenue growth. If you're using a SoFi trading platform or checking your Interactive Brokers account, the depth of the order book shows a heavy support level around the $200 mark. That psychological barrier was tested early in the month when the stock sat nearly 20% below its peak, but the recovery we are seeing today proves that the buy-the-dip mentality for Nvidia stock is far from dead. It is in fact the dominant strategy for professional wealth managers right now. The momentum we're seeing is being fueled by a few specific catalysts. First, the cooling of international tensions has allowed for a more stable supply chain outlook. Second, the anticipation for the Rubin chip family is starting to bake into the price. Everyone talks about the Blackwell architecture, but the smart money is already looking 2 steps ahead. They aren't just looking for investment help, they are looking for a way to front-run the next 3 years of data center expansion. Analysts are now suggesting that global capital expenditure on data centers could reach $4 trillion by 2030. When you look at that through the lens of a Fidelity brokerage or a Robinhood app, the scale of the opportunity is almost hard to wrap your head around. It makes the current $5 trillion market cap look like a middle ground valuation rather than a ceiling. Most investors believe that competition from companies like Amazon or Alphabet designing their own chips will eventually eat Nvidia's lunch. That's the common narrative. However, the deeper reality is that software mode. The CUDA platform has created a situation where even if a competitor makes a faster chip, it's too expensive for a company to switch their entire software stack. This is why when you check your Fidelity investments or your Robinhood investments, you see Nvidia consistently outperforming the broader semiconductor ETFs. It's not just a hardware story, it's a standard-setting story. They have become the language that AI speaks, and changing that language is a decade-long project, not a quarterly one. Let's talk about the business model for a second, because it's important to understand why this price action is happening. Historically, Nvidia was a gaming company. If you've been around long enough to remember the early days of self-investing, you know them for the GeForce cards. But today, gaming is a side hustle. Their data center revenue for the last quarter was $62.3 billion, which is an 84% increase year over year. That is a number that shouldn't exist for a company of this size. It defies the standard laws of large numbers that we usually see in the S&P 500. They are returning billions to shareholders through buybacks, with $58 billion still remaining in their authorization. This creates a floor for the stock because the company itself is a massive buyer of its own shares whenever there's a hint of a pullback. If you are using a Robinhood trading platform or perhaps checking your Fidelity mutual funds, you might be wondering about the broader macroeconomic pressures. Yes, interest rates remain a concern, and yes, the Nasdaq is at an all-time high, which usually signals a top, but Nvidia is trading at roughly 24 times forward earnings. Compare that to some of the other safe picks you might find on investing sites. Apple is trading at 31 times, and Costco is near 50. Nvidia, the fastest growing company in history, is cheaper on a forward-looking basis than a big box retailer. This is the reality that is currently clashing with the expectation of a bubble. Bubbles are defined by irrational valuations. A 24 times forward multiple for 80% growth is anything but irrational. It's arguably a discount. Institutional activity is also shifting toward more complex derivative strategies. We're seeing a lot of activity in the options market through platforms like Interactive Brokers, where traders are betting on a move toward $260 by the end of the year. This isn't just retail gambling on the Robinhood app. These are sophisticated hedges being placed by people who have a very clear view of the supply-demand balance for H100 and H200 chips. The wait times for these units haven't significantly dropped, even as production is ramped up. That tells you the demand is still outstripping supply, which gives Nvidia incredible pricing power. They can essentially dictate their own margins, which currently sit at a record-breaking 75%. I want to hear from you on this. How
How are you playing this current move? Comment below with how many shares of Nvidia stock you currently hold, or if you're waiting for a specific price target to jump back in. Does the $5 trillion market cap make you nervous, or do you see it as just the beginning of a new baseline for big tech? Looking toward the future, the catalysts are lining up for a very interesting second half of 2026. We have the Rubin chip family on the horizon, which promise to provide a massive leap in efficiency and throughput. If they can hit their marks on that release, the revenue acceleration we saw in early 2026 could actually sustain itself longer than the bears anticipate. The risk, of course, is a broader economic slowdown that forces the hyperscalers like Microsoft and Meta to trim their capital budgets. But even in that scenario, the efficiency gains provided by Nvidia's hardware often make it a must-buy rather than a nice-to-have. In a recession, companies look for automation and efficiency, exactly what Nvidia provides. The tension between what the market expects, a massive crash, and what is actually happening, consistent fundamental growth, is where the opportunity lies. Whether you use a Schwab intelligent portfolio setup for a hands-off approach, or you prefer the granular control of an individual brokerage, you have to account for the fact that the tech landscape has shifted. We aren't just looking at another chip cycle, we are looking at the build-out of a new type of infrastructure. It's the difference between building a faster car and building the highway system. Nvidia is building the highway. If you're looking for investment help or trying to decide where to park your capital, consider the sheer amount of cash this company is generating. They have $58.5 billion left in share repurchases. That is more than the entire market cap of many successful companies. When a company has that much dry power and is still growing at these rates, it creates a very difficult environment for short sellers. Every time the stock takes a breather, the company can step in and provide support, effectively manufacturing a higher floor. This is why the reality of the stock's strength continues to surprise those who are only looking at the surface-level price chart. To wrap this up, the central insight here is that Nvidia's current price of $208.27 isn't an anomaly or a fluke of a meme market. It is the result of a fundamental repricing of what a high-growth company is worth in a data-driven economy. While expectations were for a slowdown and a return to earth, the reality is that the data center build-out is likely in its early stages, with projections reaching out to 2030. The contrast between the fear of a bubble and the concrete reality of 75% margins and 24 times forward earnings is what continues to drag the stock higher. Whether you are managing your own Interactive Brokers account or using a SoFi robo-advisor to handle the heavy lifting, the lesson remains the same. Don't let the noise of expectation drown out the signal of the data. The institutions aren't selling because they see the same math we do. They see a company that has become indispensable. As we move through the rest of 2026, keep a close eye on those data center capital expenditure reports from the big cloud providers. As long as they keep spending, Nvidia will keep winning. The authority in this market doesn't come from guessing the top, it comes from understanding the floor. And right now, that floor is looking more solid than ever. Keep your eyes on the volume, stay disciplined with your strategy, and always look for the gap between what people say and what the numbers do. That is where the real profit lives in the world of online investing. Always remember that the market doesn't pay you for what is obvious. It pays you for seeing the reality before it becomes the consensus. Stay grounded, stay informed, and I'll see you in the next analysis. Disclaimer, this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, bell subscribe for more updates.